Today, silver did not politely rally. It was smashed down and then detonated upward to $106.55, like a nuclear bomb in a market that was never supposed to survive that kind of shock. And if you are confused by how a brutal price drop turned into an upside explosion in hours, lock in on this sentence because it matters. The banks are lying to you. And they are lying because a rule change slipped through the plumbing of the system while everyone was watching war drums, elections, and a shiny new battery headline. What the public saw was volatility. What the insiders saw was a countdown. Because buried inside a leaked memo that never hit the front page was a technical adjustment that quietly changed how physical silver is netted against paper obligations, and that single line item flipped the entire silver market from a confidence game into a mathematical certainty. The mainstream narrative says silver rose because of speculation, because of momentum, because traders suddenly felt brave, but that explanation collapses the moment you look at the warehouse reports, the lease rates, and the delivery notices that spiked before price ever moved, because price always lies last in a paper game. Here is the secret detail nobody on television will touch. The rule change did not increase demand. It reclassified what counts as available supply, and in a market where chemistry, refining, and logistics already run at the edge of failure, that reclassification was the match. Silver is not like oil where you can open a valve. It is not like currency where you can print a zero. Silver is a physical reality pulled from complex ore bodies where chemistry decides yield. And when you tell refiners that certain forms of silver can no longer be netted internally but must be settled physically, you have just vaporized supply on paper while doing nothing to increase atoms in the real world. That is why the smash happened first, because banks needed weak hands shaken out before the accounting change hit, and that smash was surgical, timed with thin liquidity to manufacture fear, because fear is the only tool left when physical reality corners the paper game. Think of it like this. For years, the market functioned by promising the same bar to multiple claims, rolling them forward through leases that cost almost nothing. But when lease rates jump, and the rulebook says certain bars cannot be rehypothecated the same way, every promise suddenly demands its own metal, and that is where the liquidity trap snaps shut. The leaked memo explained that after the change, internal netting exemptions would be reduced, forcing higher quality collateral or outright delivery, and to a trader that sounds boring, but to a system built on fractional silver it is catastrophic. This is where chemistry matters. Because silver is not mined alone, it is mostly a byproduct, which means you cannot simply double production because price went up. You are constrained by copper, lead, and zinc operations that are already facing declining ore grades, higher energy costs, and environmental limits. So when the paper market demands more metal overnight, the mines shrug, the refiners stall, and the only thing that can move fast is price. Now pause for a second, because this is the part where copycat channels will rush out identical scripts using the same AI avatar and the same scary music. And if you are hearing this somewhere else tomorrow, remember who said it first and why staying with the original matters, because the details are what protect you from being shaken out by the next smash. Back to the math, because math is the language banks respect even when they lie in public. Global silver demand, including industry, investment, and solar runs roughly 1.2 billion ounces a year, while mine supply struggles to clear 800 million, leaving a structural gap that has been papered over with inventory drawdowns and accounting tricks. Now apply the rule change. Assume conservatively that only 10% of outstanding paper claims are forced to seek physical settlement. That is 120 million ounces, chasing a spot market that trades maybe 15 million ounces of deliverable bars without disrupting price. And you can see why $106 was not the destination but the first pressure release. If you price that gap at even $70 an ounce replacement cost, you are talking about $8.4 billion of metal that does not exist in registered form, and that number balloons when you realize replacement cost is not spot. It is the marginal cost of coaxing silver out of declining ore with higher energy inputs. The banks knew this, which is why they smashed price first, because they needed to cap volatility while rolling their exposure forward. But once the rule went live, the game changed from timing to survival. You could see it in the spreads blowing out, in the backwardation whispers, in the way physical premiums refuse to follow futures down because physical reality does not negotiate with paper. The gold market felt it too, because gold and silver are Siamese twins in the vault, and when silver collateral tightens, gold is dragged into the same liquidity trap as bars are reallocated to meet new requirements. This is why the move was violent, because it was not emotional, it was mechanical, and mechanical moves do not ask permission. The media will tell you it is over, that the spike was excessive, that mean reversion is coming, but mean reversion only applies when supply can respond. And here supply is boxed in by geology, chemistry, and time. The leaked memo did not predict price, it altered constraints, and when constraints change, outcomes follow with mathematical certainty. Imagine a simple balance sheet, promises on one side, atoms on the other, and a line in the middle that used to allow creative netting. That line was erased, and the imbalance had to resolve through price. Even if only a fraction of holders stand for delivery, the optics alone force repricing, because confidence is binary. And once participants suspect that not everyone can be paid in metal, everyone wants to be first. This is the reflexivity the banks fear, because they cannot smash reflexivity forever, they can only delay it. Delay is what the earlier drop was about, buying time to adjust books, to source bars, to lobby for exemptions. But time is exactly what this system is running out of. Run another set of numbers. Global identifiable silver inventories sit around 2 billion ounces if you include everything from jewelry to cutlery, but investable, deliverable bars are a fraction of that. Perhaps 300 million ounces on a good day, and much of that is already spoken for. If industrial demand alone grows 5% with electrification and solar mandates, that is 60 million ounces a year of incremental pull, and the math breaks even without investors showing up. Add investors reacting to a visible rule change, and you have a feedback loop that no press release can calm. This is why calling the move speculative misses the point. Speculation chases price. This move chased solvency. The banks will respond with more paper, more contracts, more noise, but paper only works when everyone agrees it does, and agreement fractures when delivery rules tighten. Watch the lease rates, watch the warehouse categories, watch the spread between physical and futures, because those are the tells that precede every major repricing. Gold will follow because gold settles trust, silver settles industry, and when industry panics, trust is repriced upward. None of this requires belief. It requires accounting, and accounting does not care about narratives. The smash was the warning shot, the explosion was the adjustment, and what comes next depends on whether exemptions return or whether physical reality is allowed to finish the job. Because once the market internalizes that the paper game has limits, every dollar price is just a snapshot in a moving equation, and equations under constraint do not gently glide, they jump. If you feel overwhelmed by the numbers, that is intentional, because complexity is how risk is hidden. But strip it down and it is simple. More claims than metal, fewer loopholes than before, and a system forced to reconcile itself in public. This is not about being early or late. It is about understanding why $106 happened when it did, and why pretending it was random is the most dangerous lie of all. Because the rule change did not expire, it locked in, and the next move will be governed by the same math, the same chemistry, the same logistics, and the same liquidity trap tightening around a market that has no slack left. The reason this matters now is because regulatory language rarely reverses quickly, and even when it does, the damage is already done. Inventories are reclassified, risk models are rewritten, and behavior changes before headlines catch up, which is why insiders move on documents while the public waits for explanations. Every historical silver squeeze followed this pattern: a dull administrative shift, a sudden smash to test resolve, and then a repricing that looked insane until it became the new normal. You are watching that template replay with higher stakes because the global system is more leveraged, energy is more expensive, and trust is thinner than ever. Central banks understand this dynamic, which is why they hoard gold quietly while allowing silver to be mocked as volatile. Because volatility scares away casual capital even as it concentrates conviction among those who read the footnotes. When volatility spikes after a rule change, it is not chaos, it is discovery. The market discovering where balance actually lies, without the cushion of creative accounting. This is why you saw premiums decouple, why delivery times stretched, and why dealers went silent. Silence is what happens when inventory management replaces marketing. The banks will attempt to reassert control through margin changes, through rhetoric, through selective data releases. But each intervention exposes the underlying scarcity a little more, because intervention itself is evidence of stress. Think again about the liquidity trap. When liquidity exists only in contracts that reference something scarce, liquidity is an illusion, and when the illusion fades, price must do the work of rationing. Rationing through price is brutal but honest. It does not care who deserves metal. It only cares who pays enough to secure it. In that environment, technical levels lose meaning because the driver is not chart patterns but fulfillment risk, and fulfillment risk does not respect trend lines. This is also why dismissing silver as a sideshow misses the systemic signal. Silver sits at the intersection of money and industry, so stress there leaks everywhere, into credit, into currencies, into policy responses that look disconnected until you trace them back to resource constraints. A system built on abundance can tolerate waste. A system confronting limits cannot, and silver is flashing that limit in real time. The leaked memo was not a prophecy. It was a mirror, reflecting the imbalance that already existed. And once enough participants saw their own reflection, behavior shifted collectively. Collective behavior changes markets faster than any single actor, even banks, especially when rules force transparency. Transparency is the enemy of leverage, because leverage thrives in shadows, and this rule change turned on a small light in a very dark room. You do not need to assume malice to understand the outcome. Incentives are enough. Protect balance sheets, reduce exposure, transfer risk, and let price communicate the rest. That communication just happened at $106, and the volume that printed there was not retail enthusiasm, it was institutional adjustment. If that makes you uncomfortable, it should. Discomfort is the signal that a paradigm is bending. Markets bend before they break, and silver is bending loudly. Pay attention to how quickly narratives change next, from denial to justification, because that transition marks acceptance, and acceptance locks in new ranges. Once a market accepts that a higher price is required to clear constraints, it rarely volunteers to go back down without a structural fix, and structural fixes take time, capital, and political will that are all in short supply. This is the quiet part of the story. The part after the explosion, where decisions are made behind closed doors, decisions that will determine whether this was a spike or the first chapter of a repricing cycle that rewrites assumptions across metals and money alike. What happens next is where most people lose the plot. Because after the initial explosion, everyone starts looking for comfort, for a neat explanation that says the danger has passed. But markets that reprice under constraint do not offer comfort. They offer clarity, and clarity is usually expensive. The first thing to understand is that the rule change did not just affect settlement, it altered risk weighting, which means every bank, fund, and clearing member had to revisit how silver exposure sits on their balance sheet, and when risk weighting rises, capital requirements rise, forcing either liquidation or hedging with real assets. That is why gold began to move in sympathy even before headlines caught on, because gold is the pressure valve institutions trust when silver becomes unstable. This intermarket linkage is not sentiment, it is plumbing, and plumbing failures cascade. Think about central bank mechanics for a moment, because this is where the story gets uncomfortable. Central banks do not directly trade silver, but they oversee the system that clears it. And when clearing stress appears, they respond indirectly through liquidity facilities, rate signaling, or regulatory guidance that nudges behavior without admitting the problem. Those nudges often weaken currencies, and weaker currencies mechanically lift metals, which then feeds back into inflation expectations, creating a loop that policymakers hate but struggle to stop. This is why silver moves are often dismissed until they are too large to ignore, because acknowledging them early would mean acknowledging systemic fragility. The banks are lying to you not because they enjoy deception, but because truth would force action before they are ready. Another layer the media ignores is logistics. Because silver does not teleport, it moves through ports, refineries, armored trucks, and vaults, each step governed by contracts written for normal times not for sudden surges in delivery demand. When a rule change forces accelerated delivery, those logistical choke points become binding constraints, and delays translate into premiums, penalties, and eventually price spikes as buyers bid for immediacy. Immediacy is the hidden variable in every commodity squeeze, and it is brutally expensive. A futures price can say one thing, but a buyer who needs metal now will pay whatever clears the bottleneck, and those transactions anchor the next repricing. This is why spot price is a lagging indicator. It updates after the real deals are done. If you want proof, look at how industrial buyers behave. They do not chase charts, they secure supply months in advance. And when they quietly extend contracts at higher prices, that information never hits social media. It only shows up later as a mysterious trend. Now layer in chemistry again, because silver's industrial uses are not optional. They are embedded in electronics, solar, medical applications, and emerging battery chemistries that require specific conductive properties no easy substitute can replicate without performance loss. Substitution is the myth markets sell to calm nerves, but engineers know better. Substitutes increase cost, reduce efficiency, or both, and those trade-offs are unacceptable at scale. When substitution fails, demand becomes inelastic. An inelastic demand facing constrained supply produces explosive pricing, not gradually, but suddenly, because purchasing managers act before budgets are updated. That urgency is invisible until it is overwhelming. Another overlooked angle is scrap supply, often cited as the release valve that will save the day, but scrap responds to price with a lag and depends on consumer behavior, collection infrastructure, and refining capacity, none of which can double overnight. Scrap also competes with primary supply for refining slots, so increasing scrap does not magically increase output, it just reshuffles inputs. This is why relying on scrap to cap silver prices is comforting but naive. The banks know this, which is why they focused on managing perceptions rather than fundamentals, smashing price when possible to discourage hoarding, because hoarding removes metal from circulation and tightens the squeeze further. Hoarding is framed as irrational, but in a liquidity trap, hoarding is rational behavior responding to perceived scarcity. The more authorities discourage it, the more it spreads quietly. This dynamic played out in every historical monetary metal repricing, from gold confiscations to silver shortages, and it always follows the same script: denial, intervention, rationing, and eventual acceptance at higher prices. The leaked memo accelerated the timeline by forcing transparency where opacity once reigned. Transparency is destabilizing to leverage systems because it reveals who depends on whom, and dependency is weakness. Once that weakness is seen, counterparties demand compensation, and compensation is paid in price. Consider the hypothetical math again, but push it further. If industrial users lock in just 6 months of forward supply at elevated prices to avoid disruption, that pulls another 300 million ounces out of the available flow, effectively front-loading years of demand into months. That front-loading is invisible until deliveries spike, and by then price has already adjusted. This is why analysts who rely on annual supply and demand balance sheets miss turning points, because time compression matters more than totals. A balanced year can still experience a violent squeeze if timing mismatches and rule changes create exactly those mismatches. Gold feels this through collateral channels, because when silver collateral tightens, gold is pledged more aggressively, reducing its free float and amplifying its own moves. The two metals dance together not because they are the same, but because they share the same financial scaffolding. When that scaffolding creaks, both sway. The public is told this is volatility, but volatility is just the symptom. The disease is leverage meeting constraint. Look also at derivatives beyond futures: options, swaps, structured notes, all referencing silver prices that assume continuous liquidity. When liquidity breaks, hedges misfire, margin calls spike, and forced buying or selling amplifies, moves in ways models did not predict because the models assumed normal settlement rules. Every forced adjustment is another brick removed from the wall of confidence. This is why the move to $106 felt like a jump, not a climb. Jumps happen when thresholds are crossed, not when sentiment drifts. Thresholds are defined by rules, not feelings. The rule change defined a new threshold, and price leapt to find it. Now think about investor psychology, because fear and greed are usually blamed, but here confusion plays a bigger role. Confusion leads to paralysis. Paralysis leads to missed opportunity, and missed opportunity breeds regret, which then fuels late entry at worse prices. That cycle is how wealth transfers from the uninformed to the prepared. Prepared does not mean clairvoyant. It means attentive to details others dismiss as boring. Boring is where truth hides, and that is why channels chasing clicks with noise miss the real story. Staying with the original means staying with the footnotes, the memos, the settlement clauses that never trend but always decide outcomes. Another element worth dissecting is geopolitical risk, not in the sensational sense, but in how trade policy affects metal flows. Tariffs, export controls, and sanctions can strand metal in certain jurisdictions, reducing effective global supply even if total production is unchanged. A rule change that tightens settlement interacts with these frictions to magnify scarcity, because metal cannot move freely to where it is needed most. This fragmentation of markets is inflationary by nature, because it destroys the efficiency that kept prices low. The silver explosion to $106 happened against this backdrop, not in isolation, and ignoring that context leads to false comfort. The banks will attempt to frame this as an anomaly, a spike caused by speculative fervor. But anomalies do not align with warehouse stress, lease spikes, and delivery delays simultaneously. Those alignments indicate systemic adjustment. When systemic adjustments begin, they rarely resolve cleanly. They oscillate, overshoot, retrace, and overshoot again, because participants recalibrate in waves. Each wave leaves price at a higher plateau if the underlying constraint remains. That is why calling tops in such environments is dangerous, because tops require supply response, and supply response here is slow. Slow responses mean prolonged tension. Prolonged tension means more volatility, not less. Volatility scares some capital away but attracts others who understand it as opportunity. That mix increases turnover and accelerates discovery. Discovery is the enemy of suppression. Suppression relies on ignorance, and ignorance erodes when moves become too large to explain away. The $106 print crossed that line for many because it forced a question: what changed? The answer is not sentiment, it is structure. Structure does not revert easily. Even if prices pull back, the memory of constraint lingers, and memory changes behavior long after the initial shock fades. That behavioral change is what supports higher floors. Floors matter more than peaks. A higher floor means a new regime. We are watching the floor being built in real time, brick by brick, transaction by transaction, while the media debates the paint color. If you want to understand where this goes, watch not the headlines but the quiet signals, the lengthening of delivery queues, the reluctance of dealers to quote size, the persistence of premiums despite pullbacks. Those signals tell you the squeeze is structural, not emotional. Gold will increasingly reflect this as institutions seek insulation from settlement risk, and currencies will feel it as capital seeks refuge from policy improvisation. Improvisation is what happens when systems encounter scenarios they were not designed for, and this rule change created such a scenario by colliding with existing fragilities. The collision produced energy. That energy expressed itself in price, and price is the language markets speak when words fail. Words have failed here, which is why lies fill the gap. Recognizing lies is not about cynicism, it is about pattern recognition. The pattern says constraints tighten, price jumps, narratives chase price, and only later does consensus form around a new normal. By the time consensus arrives, the easy money is gone, replaced by the hard work of managing risk in a higher range. That work favors those who understood the mechanics early. The leaked memo was an early signal, not because it was dramatic, but because it was dull. And dull changes are the most dangerous because they slip past defenses. Defenses are built for crises, not clerical adjustments. Yet clerical adjustments decide crises. This is the paradox of modern finance. Complexity hides fragility, and fragility reveals itself through boring documents. The silver explosion was the moment fragility spoke loudly enough to be heard over the noise. Whether it continues depends on whether the system adapts by loosening constraints or by accepting higher prices as the cost of stability. History suggests prices are the path of least resistance, because loosening constraints undermines credibility, and credibility is the last asset institutions protect. If credibility is protected by price, price will rise until credibility feels restored. That restoration point is unknown, because it depends on trust, and trust is subjective. What is not subjective is math, chemistry, and logistics, and all three point in the same direction: tighter supply, higher required prices, and more volatility along the way. If that makes you uneasy, good. Unease sharpens attention, and attention is the most valuable asset in a market designed to distract. You are not meant to focus on rule changes. You are meant to focus on drama elsewhere. While attention is elsewhere, structures shift. When attention returns, prices have already moved. This is not a conspiracy, it is inertia. Inertia favors incumbents until it does not, and silver has reached the point where inertia is turning against the paper game. The banks sense this, which is why their messaging grows louder even as their actions grow more cautious. Loud words, quiet books. Read them, not the headlines, and you will see why $106 was not madness, but message. A message written in the only ink markets: respect, price, underlined by a rule change that cannot be unseen. Silver didn't surge because of hype or speculation. It surged because a rule changed and the paper market collided with physical reality. The smash was engineered to buy time. The explosion was forced by math. Nothing was resolved, only exposed. From here forward, price will be driven by availability, not narratives, and availability is the one thing the system no longer controls.